Hello, and welcome to the February 2023 monthly market update. My name is Ryan Flanders, and I'm the Chief Investment Officer here at the Flanders Group in Bel Air, Maryland. Now, as we turn the corner from January into February, we're left wondering the answer to a few important questions. Was January's upbeat market sentiment a sign of changing times or simply a bear market rally? Who will win this year's Super Bowl between the Chiefs and the Eagles? And will Punxsutawney Phil see a shadow? Speaking of Groundhog's Day,
Did you know that Punxsutawney Phil has been predicting the weather since 1887? This year will be his 136th year of checking for his shadow. How accurate is he? According to the data from the Storm Facts Almanac, Phil's predictions over the last 127 winters have been correct only a measly 39% of the time. His predictive powers are slightly better when he sees a shadow, with a 47% success rate over these last 15 instances. Unfortunately for our furry friend, this means a coin flip is more accurate than he is. With that level of success, Phil may have a future career predicting which way the stock market will go.
before we dive into the economy and the markets, let's take a quick look at this month's finance tip on 3 retirement planning steps that you can put into action today. Budget, save, invest.
Is one of the most important things you can do to set yourself on the path toward your retirement goals. But like many people, you might be unsure how to get started. Let's take a look at 3 financial planning steps you can put into action today. Budget. Taking a close look at how much you earn and what you currently spend your money on is the first step. What are your essential expenses, like rent, groceries, and transportation? Next, determine your non-essential expenses, going to the movies, a cup of gourmet coffee. See where you can cut back and write it down or enter it into an online budgeting program. This will allow you to see what you have to work with and where you can make smart choices about your financial future. Save. Now it's time to tuck some of that newfound money away. Remember, it's never too early or too late to start saving for retirement. An IRA or your company's 401k plan is a great place to start. You'll enjoy some tax benefits, and your company may even reward you by matching a portion of the money you invest in your 401k. That's right, free money to help kickstart your retirement piggy bank. Invest. The investments you choose will depend on your age, your tolerance for risk, and when you'd like to retire. But don't worry, you don't have to go it alone. Retirement plans like 401ks usually offer investments called target date funds, professionally managed mutual funds that take the guesswork out of investing. A financial advisor can help you through the decision-making process. Budget, save, invest. A plan to help you make smart retirement choices today. Your future self will thank you.
After a tough December, markets bounced back strongly in January. U.S. markets were up for the month with gains across all of the indices. Markets abroad did even better than here in the U.S., and even the bond markets rallied strongly. After a difficult 2022, it was a good start to this year. Typically, markets see strong returns in the month of January, especially on the heels of a poor prior year. With things like end-of-year loss harvesting and some window dressing by portfolio managers, investors have a habit of swooping in at the start of the year and picking up discounted shares of some of the stocks that may interest them. And this may partially explain some of the gains that we observed last month in January, but other factors helped as well. So what drove the gains was the continued drop in inflation and the ongoing decline in longer-term interest rates, as the benchmark yield on the U.S. 10-year Treasury note dropped by almost 50 basis points, down to below 3.5%. And with the expectation that inflation will continue to trend downwards, markets are betting on the Federal Reserve nearing the decision to pause their rate increases. Expected lower rates typically translate to higher bond and stock prices, and that's just what we saw last month. While the market was growing last month, the economy was actually slowing. It may seem counterintuitive that our slowing economy was one of the factors that led to last month's market gains, but it is part of the reason the market sprung to life last month. With pullbacks in consumer spending, business confidence, and business investment, we may be finally beginning to see the effects of a year of interest rate increases beginning to trickle into our economy. The odds of a recession occurring in 2023 are still about a coin flip, and that continues to be one of the main risks of this year. This is not something to be too concerned about there right now. Job growth is still incredibly strong, and while consumer spending has pulled back a little bit, consumer confidence still remains very firm as well. And these two factors mean the impact to the average person should be pretty limited if a recession does occur. Keep in mind, the Fed has been hoping to see the economy begin to react like this to their tightening policy. And evidence of a recession could lead the Fed to pause their rate increases, or they could even take it a step further and begin to cut rates. So while we've been preconditioned to believe that the market has to go down in a recession, the reality is we're living through a period when we could actually see the markets rise as the result of a recession. I know no one really ever wants a recession to occur, but they are a normal part of our economic cycle. With the tailwinds a recession may create, now is as good of a time as any for it to actually happen. Economically, we're off to a good start to 2023. Inflation looks to have peaked, interest rates are trending down, and while the odds of a recession are elevated, conditions are currently favoring a mild one should it occur. And these favorable economic conditions are leading to favorable market conditions, and this year looks likely to be much better than the last. As cautioned last month, we're not completely in the clear though, even if we can avoid a recession. There's still obstacles that we must continue to navigate, such as the difficult political situation here in the US, with the debt ceiling at the top of that list. As we look overseas, we await an eventual resolution to the war in Ukraine and to see if the Chinese economy can strongly rebound now that their COVID restrictions are easing. And those are only the known risks. As we saw in 2020, there's always the risk of the unknown causing disruptions as well. But as we fast forward out to the second half of this year, we'll have answers to what are still currently questions. And that's the bottom line. When things are likely to get better, the downside risks tend to remain contained, and that's where we are right now. The risks are still real, but we are continuing to navigate past them and are beginning to quicken our pace into more positive territory. That's it for this update. We're looking forward to our future segment answering your questions. We've gotten some really good ones, but we're still looking for more. I encourage you to send them to ryan@flanderscpa.com. Thanks for watching. We hope you have a wonderful month ahead. Join us in March for the next one. Thank you.